Are you hearing that cracking sound in financial markets right now? Financial markets and stock markets specifically are certainly going through some turbulent times, with the 10-year US Treasury yield flirting with the 5% level. The narrative that dominated the longest bull market in history following the 2008 financial crisis, that the Fed and other central banks all around the world are just going to hold interest rates very low and everyone on Wall Street will benefit no matter what they invest in, simply no longer holds true. It seems like for the first time in years, investors must recalibrate their investment approach and asset class decisions. So what I want to do in this video is help you navigate this market by touching on a topic that Chris Meyer recently addressed in a blog post, that an article in the Singapore Business Times discussed, and that a lesser known investor talked about on a podcast recently. So without further ado, let's get started. Okay, hey there, my name is René Zellman, and as always I've prepared a little presentation for you, and let's jump right into it. So how do you actually maneuver difficult markets, and which mistakes should you avoid making? Let's have a quick look at the table of contents. So what we will do is, I will first very briefly talk about the discipline of portfolio management and why this discipline can be so challenging and important for every investor basically. We'll then take a look at the types of stocks that you better do not touch during difficult market environments. We will then take a look at what Chris Meyer recently published on his blog post, and I will share a few key quotes from that blog post that will hopefully make you a better investor. I will then include a little excerpt from a podcast that I listened to quite recently. I think this, or the insights shared by the investor in this little clip, can be particularly insightful as well. And finally, I will talk a little bit about the stock of Matter, which I own in my portfolio, and some of the considerations that I have recently made. So let's start with the first chapter, portfolio management. As I said, this is an incredibly complex discipline. And obviously this is something that I talk about in my mentoring program too. And in my mentoring program, for example, we cover a wide range of topics. For example, the topic of asset allocation, cash management, when to buy and sell stocks, whether you need certain industry exposure, how to think about different geographical exposures, how many stocks you have to own in your portfolio in the first place, and as I said, much, much more. And the topic that I want to focus on a little bit in this video is actually when to sell stocks and when not to sell stocks. Of course, I think the selling part of the portfolio management discipline might be the hardest part of all of the aspects that I have just mentioned. Selling is certainly much harder than buying. Of course, buying stocks is fairly straightforward. You buy stocks when they are trading at a price that is significantly below their intrinsic value. That's basically the only reason to buy any assets. And selling, on the other hand, is a lot more complex because you might sell a stock for all sorts of reasons. Maybe the business is facing some very fundamental challenges and the business as a whole might be fundamentally deteriorating. And if this is not just a short-term hiccup, but more of a long-term headwind the business is facing and has to overcome, this might be a good reason to sell a stock. Maybe there is a transition in management team. Maybe the stock has reached a valuation that is simply too rich. Maybe there are more attractive opportunities in the market and you want to deploy your capital into another asset, another stock that is promising to deliver better returns. Just to mention a few possible reasons to sell a stock. And so that is something I want to talk about a little bit today. And the overall premise that I want to stress and teach you here is that you should leave your compounding stocks alone for the most part. So let's do a little thought experiment here. So imagine you bought a stock around 10 years ago in September 2013 for $43.80. Now fast forward 10 years and the stock is now trading at a price of $373 a share. That sounds great, right? Basically, you compounded your capital at a compounded annual return of 23.3%, and this performance would obviously beat the vast majority of all publicly traded assets. The numbers here become even more impressive and desirable if we compare this performance of this stock to the performance of the index. So over the same time period, the last 10 years, the S&P 500 has actually returned 9.6% annually, which obviously compounded over 10 years will lead to a much worse final result. So I would have to do the math here, but it's fair to assume that the stock that we talked about will increase your net worth by a multifold of the increase of the S&P 500 over this 10-year period. All right, so that's amazing, right? You have found a stock that has beaten the market by a wide margin and has significantly increased your wealth. However, that's not the whole story. Of course, I'm going to show you a graph now that is kind of drawing a different picture. So what you can see here is basically the same stock that has compounded investors' capital at a rate of 23%. But what we can see here is the drawdowns that investors that were invested in that stock had to endure. And what I'm revealing here already is that the numbers that I was just presenting to you are the numbers of Netflix, which has been, I think, one of the best performing stocks over the last decade. But what we can see here is that I've drawn a red line that is showing the 30% drawdown from a previous peak mark. And what we can see here is that Netflix stock in particular has been incredibly volatile. Basically, the stock has gone through three 75% or more drawdowns from a previous peak, and there are some more drawdowns of 30% in between as well. So the question you have to ask yourself is, to enjoy the returns of 23% and something compounded over 10 years, you had to be able to hold onto the stock despite its massive volatility. And you have to honestly ask yourself whether you would have been able to hold onto the stock whenever Netflix was facing some kind of short-term headwinds or some kind of difficulties. And the media would have likely been all over the place, like more recently, for example, with subscriber growth slowing, everyone was bearish on Netflix. But as you can see, the stock has basically recovered quite nicely. And I recently came across a great article by John Wee Leong, which was titled "Buying a Good Stock is Easy, but Can You Hold?" And in this article, he was also referring to Netflix. And let me just read you a little excerpt from that article. So the author wrote, "Netflix stock price history shows you how hard it is to buy and hold a stock, even when it turns out to be a big winner. In theory, it sounds easy to buy a stock and do nothing, but in reality, many investors lose their nerves and sell too soon, before the stock actually reaches its full potential. That's a painful mistake because you miss out on the chance to make huge gains on your investment. It's like having a winning lottery ticket in your hands and throwing it away." And I like that lottery ticket comparison. So here's one quick rule of thumb that you have to internalize if you want to actively invest in stocks. If you want to enjoy the returns of a 100 bagger, you must be able to hold onto a 100 bagger. And you could even replace that term here with a 10 bagger. Most stocks will not increase in value 10x or 100x over, say, 1 or 2 years. Now, likely this will require a multi-year period, and for many stocks, actually 2 or even 3 decades. And over such a long time span, obviously the stock will go through hiccups. There will be difficulties that management has to solve, and you as an investor have to continuously verify whether your long-term thesis is still intact. And if it is, you have to hold onto that stock. That stock that has compounded so nicely in the past is actually very likely to continue compounding at a satisfying rate going forward, because on average, again, that's just a rule of thumb, but on average, compounders tend to continue compounding in the future as well. And I actually want to show you a couple of other examples. So for example, Nvidia is another stock that has beaten the market quite handily over the last 10 years. In fact, it has generated returns, so total shareholder returns of 10,000%, a little more even. But just like Netflix, investors had to accept some kind of volatility, especially over the last 5 years. The business actually declined in value. No, not the business. The stock, of course, declined in value, in price, by more than 50% twice. Okay, another example is Amazon. As you can see here, over the last 10 years, Amazon delivered returns of 660%. However, over this 10-year period, investors had to go through 4 instances of drawdowns that almost reached 30%, or in some instances exceeded the 30% drawdown from a previous peak mark. And especially more recently, Amazon has actually experienced a 50% drawdown, the only one over the last 10 years. And then finally, we have Apple, another spectacular winner over the last 10 years, generating total price returns of 850%. But as you can see, Apple too has been particularly volatile, declining from a previous peak by more than 30% on 4 occasions as well. So what do we make of all of this? Another point I want to drive home and want to teach you is that price tends to drive narrative. So what you have to understand is that if a stock price is going up constantly, it's easy to overlook some of the problems the business is facing. But at the same time, if a price keeps declining, it's also quite easy to overlook the advantages and fundamental strength the business might still possess. So I want to caution you to not fall in love with the stock on its way up, but at the same time, you don't want to fall into hate when the price of a stock keeps declining or is flat for a long period of time. I think the best investors in the world, they can keep a focus on the business itself, ignore the performance of the stock price, and carefully assess how the business has developed and not how the stock price has developed. All right, as I said, we are going to take a brief look at a blog that Chris Meyer recently shared. That blog post was basically just titled Drawdowns, and I've included 3 quotes from that blog post that I think are particularly enlightening. So he wrote, first of all, drawdowns are part of the life of every investor. Invariably, if you own a stock for a long time, you're going to have to sit through several drawdowns. And I've just shown you this by highlighting a couple of examples. And if you want to take a look at some other charts, stocks that Chris Meyer included in his blog post, and I will, by the way, put a link to his post in the description box down below, are, for example, Evolution Gaming. I think he is also owning a Polish company. And then there was a third example he was including in his blog post as well. Then the next quote, the rational mind hunts for reasons for these declines. Our brains want a narrative. And so we find reasons or we make up reasons, but do they really matter? That is basically what I addressed on the previous slide as well. Price drives narrative, and you don't want to be influenced by that thinking. No, you want to focus on the business alone and not the price and the narrative that the media is basically drawing around the current developments. And then finally, in summary, there's no defense against drawdowns if you are committed to a long-term ownership approach to stocks. In fact, I would go so far as to say that the ability to sit through drawdowns with equanimity is a source of outperformance. It's a competitive advantage over those that can't. Okay, and with that being said, let's move on to almost the last part of this video. I will also talk about matter later on. So what I want to do now is I want to show you a quick excerpt from a podcast that I listened to quite recently. The podcast is called The J. Rowe Show. It's John, I'm sure I'm going to mess up his name, John Rotoni. I'll show you the real name on screen right now. And he interviewed Dan O'Keefe, who's basically a portfolio manager at Artisan Partners Global Value. And in this interview, Dan O'Keefe was also talking about the risks of selling long-term winners and quality stocks in exchange for lower quality stocks. So with that being said, let's just listen what he had to say.
So let's jump to that question now and dive into when do you sell a stock, and maybe a little bit more about under what circumstances you will hold on to a stock that has reached your estimate of fair value or maybe even run past your estimate of fair value.
Well, let's answer that by making a few observations. I'm going to simplify.
Yeah.
Right. You make money in 2 ways. You make money from a multiple revaluation, buy something at 10 and it's worth 15, and or you make money from earnings growth. I'm oversimplifying, but I think it's a fair exercise. So you buy
Sure.
something at 15 and it grows at the earnings per share, the value per share grows at 10% a year. Now, the best of all of possible outcomes is you buy something at a discounted multiple that grows, and you generate 2 sources of return: the multiple expansion or multiple normalization and the earnings growth.
Yep.
Now, when it comes to a sell discipline, it's been my experience that it's very good to sell businesses, average or even below average businesses, pretty much immediately when they hit your fair value estimate. So to go back to an example, you bought something at 8 times earnings, it goes to 11 times earnings, you've made a really nice return, but because it's not a great business, there's very little earnings growth. And so you ask yourself, well, where am I going to get my return from here? Is my earnings growth going to be much? No. Is my multiple expansion going to be much? No. So if things go wrong, I'm gonna get derated on the multiple, which could be significant, could be 20 or 30%. And I'm not going to have much earnings growth to bail me out over time. So it could take me a long time to recover that.
Yeah.
If it's 3%, simplistically, if it's 3% earnings growth and you've derated by 30%, it's going to take you 10 years without multiple expansion.
Wow.
Now let's take another example. If you own a great business and you bought it at 15, it grows 10 or 15% a year, it re-rates to 20, you made a good return, and it's now at your quote fair price, maybe 20 times earnings, but you're getting a 10% return from your earnings growth. Do you sell it? Well, if it declines by 10%, you've only got 1 year or less of, around 1 year of earnings growth to bail you out, plus time value. So if you lose a little bit of money from here, you're gonna recover value in a fairly reasonable amount of time just from the earnings growth. So it shows you that time is on your side with good businesses and businesses that grow value, and time is either neutral or against you in average or below average businesses. So if you get a below average or an average business, you get it to re-rate, you should sell it. If you have a great business and it's re-rated, but you're confident that value is going to continue to grow, you hold on to it.
So in a way, what he was describing reminds me of this illustration that I was sharing quite recently on Twitter. I think I might have shared it on YouTube as well. So basically, compounding stocks are obviously growing pies. They are increasing in intrinsic value, hopefully every single year, but especially over the long term. There may be short-term periods where they do not increase in value, but that's okay too. Over the long term, they increase in intrinsic value, and obviously this is going to give you a margin of safety. So if, for example, a stock increases in intrinsic value, but the price stays flat for quite a long period of time, well, then obviously the valuation will become more attractive. And at some point, I can promise you that the true intrinsic value of the business will be reflected, and the growth in intrinsic value that the business has delivered over that period will then be reflected as well. So that characteristic, the continuous growth in intrinsic value, is definitely a margin of safety that lower quality stocks that do not increase in intrinsic value, where you might aim for some kind of return by an expansion of the multiple, well, that margin of safety is not existent in those lower quality businesses. And this brings me to Matter. I was recently thinking about, well, what do I do with that position? The market is going through a lot of turmoil, and obviously there are a lot of opportunities in the market right now. I would argue that the opportunity set right now is more attractive than basically ever over the last 10 years, with the only exception maybe being the COVID 2020 bottom. But that period was obviously super short and really required you to act very quickly. So I have considered actually trimming Matter a little bit to deploy some of the capital to other stocks, but I haven't done so far. So what you have to understand is that Matter obviously has been the biggest winner in my portfolio in this year, and as a result, it is the largest position in my portfolio. It's quite significant, the weight right now, and you might argue that you can manage your risk now by taking some money off the table and putting it into different stocks. However, I think the current valuation of Matter, I actually prepared a slide of this, is in a way probably reflecting fair value, but it's certainly not like super exuberant or rich. Matter is trading at around 22 times its operating income, and the business of Matter, so the business asset, is super valuable. There are just a lot of things to like. The business has, in my opinion, a lot of optionality. Mark Zuckerberg is making a lot of good decisions. I'm having a hard time predicting how AI will actually benefit Matter, but I am absolutely convinced that Meta will be a big beneficiary. I like the level of execution here and how quickly Matter is moving. So I'm not sure. I think I will keep the position as it is because, as I said, basically that was the point of this video. I think selling Matter here to put that money into maybe lower quality assets, lower quality stocks, might turn out to be a big mistake. And what I will say is that I know that many people have actually trimmed their position already in the past on the way up, and I'm actually quite proud on the fact that I haven't trimmed Matter at all so far. So from the bottom in, when was it, November 2022, below $90 a share, the stock is up big time, like more than 200%. And I think it was always quite tempting to take some money off the table to lock in some of your gains. But personally, I don't think the price is really exceeding the true value of Matter significantly as of now. And I believe that Matter will continue to grow in intrinsic value over time. So I really saw no point in selling Matter so far. Right now I'm considering it a little more because of the opportunities that the market presents. But what I think you also have to realize is that when you take some money out of a stock that has delivered great returns for you and put it into a new stock, there's maybe a hidden risk here. Because I would argue that you only truly understand a business once you own it. And obviously my understanding of Matter as a business will be much better than my understanding of a business that I have maybe more recently started looking at more closer. Maybe it is already on my watch list and I have done some research in the past, but still, I think my understanding of Matter as a business is probably better than my understanding of any alternative. And so the range of outcomes here might actually be much wider for new positions. And I think that's just something to be aware of. So we will have to see how this unfolds, but I just wanted to share my thinking on Matter specifically. And with that being said, I'll wrap it up here. See you in some of my future videos. Take care.